Boy, has this market had a hard time trying to figure out what to pay for bank stocks. It's been a constant theme in 2018, but it's really been in your face this earnings season. First, we got some excellent numbers from J.P. Morgan. The go unrewarded group tumbles. Then the whole group roars when Bank of America reports a good quarter earlier this week. Sometimes it feels like you never know how the market's going to react. But there's one thing we do know. If a bank disappoints on any big line, its stock is going to be punished. Just look at the recent action in First Horizon National, FHN, for all you home gamers. The Tennessee-based regional bank with more than 300 locations across the Southeast. Yesterday morning, First Horizon reported inline earnings with analysts bemoaning weaker than expected revenues. And while the absolute numbers were pretty strong thanks to the recent acquisition of Capital Bank, Wall Street was not impressed, and the stock dropped 4%. It's now down 14% for the year. So what's happening here? Let's dig deeper with Bryan Jordan. He is the president, chairman, CEO of First Horizon National. Find out more about the quarter and his company's prospects. Mr. Jordan, welcome back to Mad Money.
Thank you, Jim. It's great to be back.
All right, Bryan, I've got to tell you, I go through the quarter and I see net interest margin doing well, the acquisition doing well. Some of the analysts tell me, okay, look, the revenues weren't up to snuff and that's why it went down. I want to give the ball to you because I think that there must be more going on here. You run a great bank and the stock has been under a lot more pressure than it should be.
Yeah, thank you for the opportunity. I am excited about how we're positioned and I'm excited about the momentum that I see in our business. If you look at our first couple quarters of this year, we spent a tremendous amount of time focusing on the integration and doing work to make sure that we minimized any adverse impact on customers or customer relationships. And that involves everything from training to conversion communication. We came out of the conversion Memorial Day weekend with pretty strong loan growth for the quarter, about 8% annualized, period end 4 to 5% loan growth. Our net interest margin improved for the quarter. Our deposit trends were strong. And we came out with what we thought was very good momentum in our banking business. Our fixed income business was off a little bit in the quarter, and that impacted our top line revenue growth. That has to do more with something we talked about a while back with the volatility in interest rates and a 3% 10-year. But all in all, we feel good about the momentum we're seeing. Credit quality continues to be good. Our economic backdrop is still very, very strong, and we're looking forward to a very strong back half of the year. So I'm excited about how we're positioned and very optimistic.
Well, talk about the capital acquisition. Since Memorial Day, you've had not that much time to look at it, but a good solid month. And you're in the Carolinas, which are a fantastic economy. We know that where you are is a great economy. The pipeline must be pretty full.
Yeah, the pipelines are very strong. I mentioned yesterday on our earnings call, our 50% probability pipeline at the end of June was $2.4 billion. That's relative to a last 6 month and end of last year average of about 1.9 to $2 billion. So somewhere between 20 and 25% stronger, which is very good. We have something like 306 deals where we've either completed or about to complete what we would consider revenue synergies, where we've got a sale or a cross-sale or a product feature or service that is being driven by the integration. That totals about $17 million in annualized incremental revenue when that is done, and we think we build from there. So as we look at the integration and the Capital Bank markets, we see a tremendous amount of opportunity. The markets in North Carolina, South Carolina, and South Florida that we now have an opportunity to grow in are extraordinarily strong. They are markets that look and feel a lot like the major MSAs in Tennessee. We believe very strongly in the team of bankers that came on board with Capital Bank. We believe strongly in the markets. And so we think there's a lot of growth opportunity, organic growth opportunity in particular for us.
Okay, how about capital? I know, for instance, Keep What I like to say, they're saying capital is somewhat thin, but they would expect that maybe you can do some buying back of stock given how low the stock has fallen. Could that be in the cards for First Horizon?
Yes, we retired about $40 million, $45 million worth of stock in the second quarter of this year. And we have, we think, plenty of excess capital. We've stated for, if you go back 8 to 10 years, we've sort of changed the underlying metric just a bit, but essentially equates to about an 8 to 9% Tier 1 common stock ratio. We're at 9% at the end of the quarter, so we believe we've got plenty of room in that range, and we can take opportunity to pick up some there. The other thing that we have sort of a hidden capital buffer as an issuer of Visa and a receiver of Visa stock, we have something in the $250 million plus range of Visa stock that has about $250 million in economic value and a zero basis on books. So that in and of itself creates a capital buffer. So we believe we have the flexibility to take advantage of lower stock prices here, the stock being on sale, and pick up a little bit.
Well, I couldn't agree more. The stock is definitely on sale. Doesn't make a lot of sense to me. I want to thank you. That's Bryan Jordan. He's Chairman, President, and CEO of First Horizon FHN. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.